This video is sponsored by Celsius. No, I'm just kidding. Do you ever get triggered when you hear the acronym CPI? As traders, CPI is one of the biggest events that causes massive fluctuations recently in the markets. So in this video, I'm going to explain simply what is CPI and why does it matter in terms of trading and the markets. So first of all, what is CPI? So CPI is simply the Consumer Price Index. It measures the monthly change of the prices of goods paid by consumers. Now CPI is measured by the Bureau of Labor Statistics. CPI is a very good measure of inflation and is closely monitored by financial markets as well as policymakers. The data that goes into CPI are price quotes from thousands and thousands of services as well as products from retail stores. Also, what goes into this data are housing rents and shelter costs. Now, why does this all matter for the markets and as a trader or investor? Well, CPI is one of the measures most closely followed by the Fed, aka Papa Powell. So Jerome Powell, the head of the Fed, or the Federal Rates Committee, follows CPI very closely in order to make their decision on whether they're going to hike rates, pause rates, or cut rates. Now, what does the federal fund decision have to do with anything? Well, the increase or decrease in rates can affect the amount that you're paying on consumer loans, on car loans, and also on mortgages. So the rates that you get from credit card loans, car loans, home loans, all of this is factored in when the Fed is making their decision. And their decision is based on whether or not they need to make changes in the federal fund rate in order to get a hold on inflation. Now, the federal fund rate is basically the rate at which commercial banks lend and borrow money to each other overnight. Now, we can get into this in another economics video, which will be coming soon, but currently we're working on the trading crash course video. So if you haven't already, check out the trading crash course here or here.